One of the biggest fears investors have is this: what if I invest all my money and the market crashes the very next day? This single question stops more people from investing than bad returns ever do. It creates hesitation, it creates delay, and for many people, it creates permanent inaction. Today we're going to deal with this fear directly, not emotionally, not with motivation, but with data, logic, and perspective. We're going to compare lump sum investing and SIP investing and ask a very uncomfortable question. What actually happens if you invest at the worst possible time, at the top of the market? Let's start with definitions. A lump sum investment means putting a large amount of money into the market at once. A SIP, or systematic investment plan, means spreading that investment over time. Same money, different timing. Most people believe SIPs are safer and lump sums are risky. But the truth is more nuanced than that. Now imagine this situation. You receive a large amount of money, a bonus, an inheritance, a maturity amount. You want to invest it, but the market looks high. Headlines are optimistic, prices feel expensive. This is where fear enters. You worry about buying at the top, so instead of investing, you wait, or you choose a SIP. But what if you did invest at the top? Let's test that fear. Imagine you invested a lump sum at the worst possible time, right before a major market crash. The portfolio immediately goes into the red. Losses appear on the screen. Emotionally, this feels terrible, and this is why people avoid lump sums. But here's the first important truth. Short-term loss does not equal long-term failure. Markets fall, but they also recover. Every major crash in history has eventually been followed by a recovery. The timing feels disastrous. The outcome over time is often not. Now let's compare this with a SIP. If you invest the same amount via SIP over, say, 12 or 24 months, some of your money goes in at high prices, some goes in at lower prices. The average cost becomes smoother. Emotionally, this feels safer. You don't see a large loss immediately. But here's the trade-off. While you are spreading your investment over time, part of your money stays out of the market. And money that is out of the market does not compound. This is the hidden cost of comfort. Now let's look at actual behavior during crashes. When markets fall sharply, SIP investors benefit. They buy more units at lower prices. But lump sum investors feel pain first and recovery later. So the real difference between lump sum and SIP is not returns. It's emotional tolerance. Now here's where most people get confused. They believe that investing at the top permanently damages returns. But data tells a different story. If you invest a lump sum at the peak and stay invested for long enough, the impact of that bad timing shrinks over time. After 5 years, the difference reduces. After 10 years, it becomes surprisingly small. And after 15 or 20 years, it often becomes irrelevant. Time smooths bad timing. This is something most investors underestimate. The longer your horizon, the less timing matters. This is why long-term investors can afford lump sums, and short-term thinkers cannot. Now let's flip the question. What if you wait to invest until the right time? This assumes you can recognize that time. Most people can't. Markets don't announce bottoms. Fear is highest at the worst moments. By the time confidence returns, prices have already moved up. So waiting often results in buying later at higher prices, which ironically creates the very problem people were trying to avoid. Now here's the key insight. The real risk is not investing at the top. The real risk is never investing because you fear the top. One is a timing error, the other is a permanent opportunity loss. Now let's talk about who SIPs are actually for. SIPs are not designed to beat lump sums in every scenario. They are designed to manage behavior. They protect investors from emotional extremes. They reduce regret. They reduce stress. They keep people invested, and that has value. But SIPs are not magic. They do not guarantee better returns, they guarantee better discipline. Now let's talk about lump sums again. Lump sums are mathematically efficient. Markets over long periods tend to go up, so investing earlier gives money more time to compound. But lump sums demand emotional strength. You must tolerate volatility, you must ignore short-term losses, you must resist panic. This is why lump sums work well for experienced investors and poorly for anxious ones. Now here's the practical takeaway. This is not about choosing lump sum or SIP. It's about choosing the right tool for your situation. If you receive a large amount of money and volatility scares you, a phased SIP approach makes sense, not because it's mathematically superior, but because it helps you stay invested. If you have a long horizon, strong discipline, and the ability to ignore short-term noise, a lump sum may actually work better. The mistake is treating one method as universally superior. They solve different problems. Now let's come back to the original fear. What if you bought at the top? The honest answer is this. It will feel bad at first. You will see losses. You will question yourself. But if you stay invested long enough, that decision alone is unlikely to ruin your financial future. What ruins financial futures is repeated hesitation, constant waiting, endless fear, and the refusal to stay invested. Time heals bad timing, but nothing heals money that never entered the market. This is why long-term investors focus less on entry points and more on staying power. They accept that some investments will start badly, but they trust time to do the heavy lifting. This is the mindset shift most people never make. They try to avoid discomfort instead of maximizing duration. And duration is what builds wealth. So the real question is not, should I invest via lump sum or SIP? The real question is, which method will help me stay invested the longest? Because the market does not reward perfect timing, it rewards persistence. This is the wealth blueprint. And understanding this difference is what separates fearful investors from successful ones. Subscribe if you want clarity, not hype.